everyone, and thank you for joining today. This is the inaugural YouTube video, I suppose, on this hypothetical portfolio that I have created here, and I'm glad to see that you're interested, and hopefully I can add a little bit of value to your life, maybe share some interesting things over time. So initially, of course, I've got to say this isn't investment advice, so please do not take it as such. It's again for educational purposes, for myself and for you, hopefully. It's a fun exercise as well, right? I'm going to put some effort into this and manage this portfolio much like I do my actual portfolio, but we'll keep track of it and have a nice official record for public purposes, I suppose. And yeah, we can just sort of invest along together without actually investing, again, because this is an investment advice, of course. So yeah, without further ado, let's get started here. I wanted to build a portfolio here, in large part because of where the market is. The timing of this, I think, is interesting right now. Backing up a little bit, 2021, the market was, I think, quite overvalued, certainly on the tech side. Interest rates were very low. The discount rate was sort of essentially being treated as zero. And so you had these wild multiples where, a tech company could be trading at 20 to 40 times sales quite easily. Flip forward to where we are today, where, I've been buying over the last year, let's say, or certainly 6 months, getting quite aggressive. It's a very different environment where you have price to sales multiples of like 1, 2, predominantly single digit, even for some of the better companies. And so I think it's a really interesting time. I think, additionally, the Fed has been raising rates, of course, and that's been putting a lot of pressure on multiples and just cash flow in general, especially for companies that are levered. And so companies, I think, that have good fundamentals just aren't being valued appropriately. They're being valued with a very short-term lens. And so I think this is an interesting time as I think we're about to move into a period where the Fed becomes more dovish. And they've certainly been pretty hawkish up until now. We're actually 7 minutes away from the Fed decision here. So I think this may be an interesting turning point, and it may not, but I think within the next probably 6 months at least, we'll start to see some more dovish language coming from the Fed, and I think that's likely to start to reverse certainly the valuations that some of these companies are being currently given. So this is a portfolio that I've put together. It's a hypothetical portfolio, and of course, this is not investment advice, so please don't take it as such. What it is it's meant to be an interesting exercise to, put a stake in the sand here basically and sort of say, okay, these are the, the current prices and the current weights that I would apply for this particular portfolio, which is, very growth heavy portfolio, very growth heavy portfolio, in fact. And then I also did a low risk portfolio just for fun as well, because again, with that view that I think we're going to have a dovish pivot here coming now relatively shortly. We're certainly seeing inflation year over year moderating and declining, in fact. So I think it's only a matter of time before they start to soften up and we start to see things like TLT rebound. In fact, TLT this morning was up, I think, 2%. It's maybe up a bit less now, but TLT is sort of front running, or bonds are sort of front running even today's decision to some degree. And I think, just macro, from a macro perspective, I think we're likely to be nearer to a turning point than continuation of this trend. Doesn't mean the Fed isn't going to have to come back and fight inflation later on, but I think they're likely to start to pivot to a more dovish stance. So this is the portfolio. These are the companies that I think are interesting right now. I mean, there's certainly more companies that I think are interesting than just these, but I think for the sake of this portfolio and for what we're doing here, I think this is something I like and I feel quite comfortable with. That being said, some of these weights are far too high. I mean, these are wildly, heavy weights for single equities, but, as a note here, to be reduced as these things, I think come back up from what are quite depressed levels. And then I've done sort of a for fun portfolio over here, which is a levered portfolio. So you can see 30% leverage I've applied. So you have the $400,000 starting amount that I've arbitrarily picked here, and then $120,000 loan using probably your brokerage to do that. And I'll need to adjust for the loan interest as well to reduce the profit of the portfolio from the loan interest amount. And then also for a little bit of realism here as well, I've actually reduced the book value, the starting amount, by a whopping $2.50, which is sort of roughly what I would pay with Interactive Brokers to do a trade of these sorts of values typically. So I've reduced, in fact, you can see it right here, the starting amount is not 520,000, it's 519,942.50. So that takes into account commission. And then what I have over here is the average cost, which I'll actually grab right now. So we'll do it live. We'll grab these prices. These are Google Finance prices being pulled in live, as you can see. So we'll grab these prices, and these will become our official starting values or starting average costs. So I will just paste that in here. And so those are now fixed values all the way down. And so those will apply both to the levered portfolio and to the unlevered portfolio. And yeah, so that'll give us a good starting place. Now, normally I would scale into a position. We're sort of starting point in time here as if the portfolio already existed. So the starting methodology isn't maybe the way I would typically do it, but I think, again, from a timing point of view, I think this is an interesting time to start a portfolio, and so we're going to go into it 100% invested day one. In both cases, in fact, well, 130% invested over here, of course, and then with the low risk portfolio, 100%, with some pretty heavy weights. So this one we will be changing. I won't keep it at a 40% weight to TLT. I think this portfolio has a lot of room for improvement over time, but I think this is sort of a strategic, trade, if you will, in that I think bonds have gone too far. TLT was $171, I believe, at peak in 2020. So I think this is getting long in the tooth, this decline. We're again closer to a bottom than a top, I think. So yeah, quite a large weight there, and we'll readjust this portfolio over time. But this one's sort of just for fun. This one is much closer to my actual portfolio. So I think this will be the most interesting one. And as I say, this is sort of more just for fun. So yeah, we're actually 1 minute away from the Fed decision. So what we can actually probably update these live, come to think of it, because these values are going to start to move here pretty quickly, I would imagine, as the Fed makes their decision and whatnot. Yeah, and then the other thing is over time I will go through all these individually and sort of speak to them and speak to the weights that I've applied, the differentials in weighting within the portfolio, because there's obviously a reason why I've weighted things differently and why I've given outrageous weights to a few things. Again, I'd like to bring those back down to more reasonable weights, because this isn't a well-diversified portfolio. I mean, it is diversified from a sheer number of holdings, but a 16% weight is pretty aggressive, obviously. But then again, I just don't think there's a lot of risk in these things. Like Overstock, for example, off the top of my head, has something like 300 million cash and now only a $300 million valuation, enterprise value. Market cap would still be, let's say, 600,000 or so, or 600 million, I should say. So yeah, half cash versus market cap. They have a lot of room to maneuver. So anyway, I will go through all these individually. Not today. Today is just sort of, hey, let's put a stake in the sand here and get our units and our weights, and then go from there. So it is 11 o'clock Pacific time at this exact moment now. So the Fed has actually released their decision. So let's just make sure we have this all lined up. Yeah, that's good. Maybe I'll come back and do this in a few minutes. Let's actually go take a look at what has happened right now, and then we'll update these after. But let me just confirm. Yeah, those are hard entered, and we have our units in place as per book. Yeah, so we're good. Okay, so let's pivot over and see what's going on here.
Confirming that rates have peaked. That's going to be a key question for Chairman Jay Powell coming up.
You see, Mike McKee, we want to get to you quickly here, but we see the market moving, lifting up, equities lifting up higher right now, with the Dow up 80 points, 0.2%, NASDAQ 100 on a tear up 0.8% as well. The 10-year yield comes in ever lower, bond prices up, yields down on the 10-year yield, 4.79%, distant from the 5% yield. Mike, the statement is here, and maybe it's a preparation for December 15th.
Okay, well, I'm going to pause it there. So, yeah, unchanged as expected, but slightly dovish initially, and yeah, we'll just see how it goes. So I'll update the values. Not that we care about, you know, minute by minute values by any means, but I think it'll be interesting at end of day because there will be a bit of a move here. So we'll have some new values, and then yeah, we'll just track this over time and see how it goes. I think, you know, this is something I have a fairly high level of confidence in. I mean, I've done my research on these companies and applied the appropriate weights in my view. I mean, you know, the other thing is this is a little bit of a funny portfolio, right? Because we've got, you know, mega caps and then we've got really small cap stocks mixed together, and it's there isn't a lot of rhyme or reason on that front, and especially the categories, right? I mean, these aren't you know, GICS categories by any means. They're sort of haphazard mix of categories, but again, it's sort of an opportunistic portfolio. That's the theme here. Opportunistic by sector that we're investing in, and even more so opportunistic in the particular equities. And again, there is rhyme or reason. I mean, you know, Enphase is a much larger market cap than a Stem or a Tigo, and so we do have a bit of stability, if you will, holding something like Enphase with $500 million in cash and a you know, pretty significant market cap. But anyway, we'll get into that in future videos. And yeah, so let's leave it here for now. I'll update this and get our market values all right and everything, and then this will track itself. And a couple other, you know, housekeeping comments. So yeah, we'll do, you know, apply commissions as I've done here, so that our initial investment is not 520,000 but 519, and likewise, here we have, you know, 400,000 initial, but then our actual invested amount is only 399,954. So, and then I'll have to apply interest and dividends separately as well, because this is Google Finance, so it doesn't do that automatically for you. Fortunately, on the growth side, not a lot of these pay too many dividends. You know, Camping World does, but not a lot of them do. So that will be relatively straightforward. But yeah, again, here's the portfolio, November 1st, 2023, 4 minutes after 11 o'clock, and the Fed's rate decision. And we're off to the races. So yeah, we'll keep track of this going forward, and thanks for your interest, and look forward to seeing you in future videos as we move along here and watch the portfolio hopefully grow. Okay.
So is it right to think of that as a hiking bias is still in the committee here?
We haven't used that term, but it's fair to say that's the question we're asking: is should we hike more? It's not. You know, and that is the question. And you're right that in September we wrote down one additional rate hike, but you know, we'll write down another forecast, as you know, in December.
That feels like job voting there. You know, the more that they can say they're still thinking about hiking, the more effective the policy that, you know, that they've implemented thus far is. So, you know, I think, you know, obviously employment's still strong, but I think there are things breaking under the scene, under the surface. I mean, especially in real estate, and we're certainly seeing that in Canada with, you know, development project after development project going under, or at least being scrapped, you know, in the early stages, and then, you know, we're seeing it in financials as well. So I think, you know, we are very close to at least a more permanent pause, and then, you know, I don't know about actually cutting rates. I mean, I think they'll cut rates when there's some sort of a crisis that necessitates that. But even that, you know, realization that we are at a sort of a permanent pause, I think will be not massively bullish by any means to the market, but given how depressed equities are, especially the types that we're looking at here in this portfolio, I think that would be a relief, to say the least. And I think you would see that in the numbers, you know, as the sort of the, you know, metaphorically the Fed lifts their foot off the market's throat, really, you know. So anyway, this is good to see. I mean, look, we're down a little bit here, we're down a bit here. We're like, you know, we're going in the wrong direction right off the bat. So that's okay. That's part of the process. And you know, you should be comfortable with a bit of red in your portfolio. If you're not comfortable with that, you're probably not cut out for this type of investing. And it's difficult, right? Because you need to disassociate yourself from your money in a way, right? I mean, this morning I had this much money and now I have this much money, and that's okay, because, you know, it fluctuates and it will continue to fluctuate. And, you know, I have confidence that this is undervalued at this price, right? And I'm willing to sit on a loss and whatnot. So anyway, that's good. And, you know, here we're down 4,700 on the levered portfolio. So, you know, the more it goes down, the more we'll have to actually risk manage the levered side. There's our average costs again, and I updated the fixed income to be in line with what we had earlier when we looked at it before the Fed, and, you know, more or less unchanged, so that's fine. Yeah, so that's that. I mean, the one other thing I'd like to just speak to quickly is, you know, why levered. You know, often the equity market is compared to real estate investing, you know, rightfully or wrongfully. But the thing about real estate is that there's an inherent amount of leverage, a significant amount of leverage. I mean, we're talking about, like, you know, 70–80% leverage with real estate. And that's just built in. So, you know, you invest $400,000 in real estate, and, you know, you do, let's say, you know, $2 million property 5 years ago, and say today it's worth $4 million now. Well, you only put up $400,000, and you just netted yourself, you know, $2 million profit on your cost there. But it was on a $400,000 investment. Well, is that fair? I mean, did your $400,000 quadruple, or, you know, was it the result of leverage? Well, it was largely the result of leverage, right? So I think it's appropriate to at least consider that leverage could or should be applied to equity investing. I mean, it makes it difficult to manage, and it's not for the faint of heart. And again, this is not investment advice, but if you're trying to have a portfolio that really truly grows over time, you know, having a small amount of leverage, I think, is invaluable. But, you know, it adds significant risk. Unlike this one, you know, the unlevered, we're going to be able to sit through whatever losses we have, and it's not a problem, because, you know, provided, let's just say provided I don't need this cash for my daily living, well, then, you know, it's unrealized. They're unrealized gains. We can sit on them until things start to go our way, and then it's a different situation. But initially, you know, we're going to be sitting on some losses, and that's okay. This one, again, will be a little bit more challenging as we manage the leverage if we have to, depending on the losses that are incurred along the way. So anyway, that's the portfolio. You know, not really much change, actually. I mean, well, dollar-wise, I suppose, but not a significant event. The Fed wasn't a significant event, I would say. Not at this point, anyway. Often after the presser closes, there's you know, a bit of a market move, but yeah, we'll see. So anyway, thanks again for your interest, and look forward to managing this portfolio with you and tracking it over time. So okay, thanks again, everyone.